Hello everybody. There's been a lot of talk recently about American share prices being overvalued. The measure used by the doomsters is the price-earnings ratio, which is now just over 18. Now what that means is that you're paying just over $18 for every $1 of net profit earned by a US company. If you flip that ratio, you get what's called the earnings yield. And the earnings yield is 5.5%. In other words, if you hold a broad block of Standard & Poor's 500 American shares, the biggest 500 companies in the US, your average profit relative to what you pay for your stock is 5.5%. The doomsters say this is high by historic standards. In fact, it's not high by the standards of the last 30 years, where the average has been about 18, and over the last 50 odd years, it's been slightly lower at just over 16. But what you've got to bear in mind is that a yield of 5.5% looks pretty decent when long-term bond yields over 30 years are less than 3%. And you need to see it in that context. The other thing that needs to be borne in mind is that despite the fact that the US economy had a fairly weak start to 2015, just like it did in 2014, the American consumer has a lot more money in their pockets. And that money, it's likely to find its way into spending. The evidence is that it already is getting through, because US car sales hit record levels. Actually, post the crisis, they're higher than their pre-crisis levels, and new housing starts are picking up too. The evidence is that the US consumer is coming to the rescue. That will be good for the worldwide economy, and it won't be too bad for American stock prices either.